Good afternoon, everyone, and welcome to the latest installment of the Wintrust Wealth Management Discussion Series on the economy and the financial markets. My name is Tom Zidar, and I head up the Wealth Management Group at Wintrust, and I'll be moderating the discussion today, which will focus on the Fed, monetary policy and inflation, the health of the U.S. economy, and the state of the markets, both fixed income and the equity markets. I'm pleased today to be joined by longtime panel participant Jason Turner, who is the Chief Investment Strategist and Head of Multi-Asset Strategy at Wintrust Wealth Management. Welcome, Jason.
Thanks, Tom.
Thanks for being here. And welcome also to our, I guess not long time, but second or third time panelist, Nancy Studenroth, who is Managing Director of Fixed Income at Great Lakes Advisor here at Wintrust. Welcome, Nancy.
Thank you.
Thank you to you and Jason for joining us this afternoon. So let's get started. The latest, Jason, I'll start with you. The latest meeting of the Federal Reserve, the FOMC meeting at the end of April, beginning of May, we saw that the Fed continued to leave rates unchanged, but a little different sentiment was offered. Their comments were a little more hawkish than prior meetings. So, Jason, what's your take on the most recent Fed meeting?
I think, as expected, the Fed left rates unchanged. Futures markets before that meeting were somewhere near 98% that the Fed was leaving rates unchanged at the meeting. As you mentioned, Tom, the interesting shift is a move maybe a little bit back from the dovish or accommodative policy lean that they established at the March meeting, back towards more of a neutral data dependency. So while they haven't closed the door to rate hikes, I wouldn't say they opened that door any further. Maybe a 10% chance they're leaving open the possibility of a need to hike. The clear message from the Fed, though, after the May 1 close of the meeting was the economy has not moved to a point at which the Fed feels that its data-dependent outlook would encourage it to start cutting rates anytime soon.
Got it. Thank you, Jason. So I'd like to hear about both from you and Nancy what you think about the future moves that the Fed's going to be bringing to the table. But before we do so, we're going to turn to our audience and get them to participate right out of the gate here with our first polling question. So that question is, what do you think the Fed will do with interest rates, specifically Fed fund rates, between now and the end of the year? And we've got four options for you. One is to raise rates by 25 basis points or more. Second is leave them unchanged. Third is cut by 25 basis points. Or fourth, cut by 50 basis points or more. Again, this is between now and year end. So please take a moment to respond to the polling question. So in the meantime, Nancy, what are your thoughts about the Fed and future rate adjustments?
Sure. So I think we're all finding that inflation is very sticky, and the Fed is fighting it. They have left rates unchanged. They express that they are data dependent, so I agree with what Jason is saying. I know our team, right, we're in the fixed income team, so our curve movements and exposure in our portfolios is pretty vital. Yep. As a team, we think maybe one or two rate hikes, definitely not in July. I think beginning of, end of April, people thought, oh yeah, it's going to be July, but we think they've kind of kicked that down the road, maybe September, maybe year end.
Got it. Thanks, Nancy. Jason, what do you think?
I have moderated my views on how far the Fed is going to cut along with and maybe beyond the markets. We rewind to January, and the markets were expecting 6 rate cuts this year. We get forward to March, and then it's a thought of maybe the Fed isn't lying when they're saying they're going to cut rates 3 times. At this point, it's difficult for me to see, frankly, 2 cuts from the Federal Reserve this year based on where we see inflation sitting today. There's not a lot of signal telling us that by the time we get to the September meeting, the Fed is necessarily going to have enough runway in terms of inflationary evidence to bring us back to a cutting scenario and to be confident we're getting to 2% on the inflation handle. So I would say 1 cut, likely in December. Keep in mind it's an election year. Fed espouses they're apolitical, and if they are, they're going to likely stay out of the political arena, avoiding that November meeting, which is just 2 days after the election.
Got it. Thanks, Jason. And our polling question the results have come back, and the majority of folks agree with you. 1 rate cut, 25 basis points, is more than half of the audience. Okay. Second place on that is unchanged. And then very few people believe there will be either a hike or a more than 50 basis points in cut. Interestingly, more people think there'll be a hike than more than 50 basis points in cuts. So interesting sort of histogram there with our responses. But it looks like the audience is in the 25 basis point camp, which sounds like where both of you are. Well, thank you for that. Besides managing Fed funds rates, the Fed also manages its balance sheet. And it's been in a tightening, some say quantitative tightening mode here for some time as they look to reduce the size of the balance sheet of the Fed, which we know ballooned up quite a bit after COVID. Nancy, what are your thoughts on the Fed's efforts there, and what effect has it had on rates and the markets?
Yeah, thank you. This is a great question. I think just 1 minute to take a look back historically. Basically, since 2008 through COVID, the Fed has been in a quantitative easing mode, meaning they are putting money into the market. They do it through open market policies, and they initially bought mortgages and treasuries. For many, many years, they were the buyer of last resort, and that provided a lot of stability and calm in the market. The mortgage market is the largest fixed income market, over $1 trillion. So to have that Fed as the buyer of last resort was very important. Then COVID hits, and the Fed says, oh, we've really got to step this up. They expand what they're going to buy. They move into asset backs and agency commercial mortgages, which they'd never done before, and even corporates. Now interest rates are high, or not interest rates are high, but inflation comes up and they want to manage this, so they step out. And so what that's done to the fixed income markets is caused some volatility, right? We have this giant market where the Fed was the main player, and they're not playing anymore. So the mortgage market in particular has suffered from a lot of volatility and some spread widening. So that has caused markets to kind of go into disarray on a sector level there. But it does bring interest rates up, and so now we have some yield in the market as well.
That's right. Good, Nancy. Jason, anything to add on the Fed's balance sheet moves?
Sure. For all the talk of potentially cutting rates, the Fed is still active in quantitative tightening.
Yeah.
They've reduced targets. That was the other interesting outcome from the May meeting. They've reduced their target for both MBS and Treasuries in terms of the runoff. And just explaining a little bit more what Nancy was explaining, when those run off, the Fed is in effect letting them mature, taking that money they're given from the Treasury, from the maturation, and removing it from circulation.
Right.
So they're actually doing things that are pushing rates higher. At the same time, we're talking about them cutting rates lower. So in effect, they need to taper or drastically reduce this tightening before we get to rate cuts. Just maybe another bit of evidence in my assumption that the end of December is maybe the soonest we're going to see that first cut from them. Interesting to note, though, the Treasury taper, if you will, is going to be effective in terms of reducing the amount of quantitative tightening in Treasuries. On the MBS side, they're barely half their target.
Right.
So reducing the target there really doesn't matter. They're actually month to month half of what the new target is.
Got it. Lots happening there as we've seen, and we'll talk more about the fixed income markets in a minute on that, Nance. So let's talk more specifically about inflation, which is really kind of the driver of the Fed actions of late, Jason. And been the focus really for the last year and a half of the Fed. CPI came in at 3.6% last week, pretty much as expected, but it still remains stickier. Inflation remains stickier than many had anticipated. What's driving this stubbornness of inflation, Jason?
Well, inflation's absolutely stickier than most had anticipated. Everybody thought with the Fed getting as restrictive as they got, moving rates as quickly upward as they did, that you would see a rapid response to inflation. And in reality, we saw inflation start to react before Fed policy had really taken hold. That tells us a bit of a story that inflation moved not on a policy change, but more the resolution of supply chain issues that we experienced in 2020 and 2021. So as those started to resolve, we started to see inflation recede. On a headline basis, though, whether we look at core or we look at the headline rate of inflation, for CPI, you're seeing inflation leveling off. The core rate, its improvement on a month-to-month basis has declined to a very negligible month-to-month improvement. The headline rate has actually bounced around to slightly up to flat over the course of the last several months. So inflation's progress appears to have stalled out about 1.5% higher than what the Fed's target is. It's interesting, though, that there's a change in the composition of inflation. And that change in composition has seen it shift from, in 2021 and 2022, during the run-up, being tied to goods, to now being tied to more services, with a very large component, what we'll call housing, at 45% of CPI, making up, in effect, a artificial floor for inflation, that inflation really can't fall past. Housing running at 5 to 5.5% now in terms of inflation and housing at 45% of the market. That creates a floor well above 2% that inflation can't seem to fall back through.
Yeah, they just showed it, Jason, on the screen. I don't know if you saw it, but they had how much housing comprises of that index is substantial, and so it's a big driver as we've seen the stickiness in the price of houses. Can you look ahead, Jason, for the rest of 2024, and sort of what's your particular outlook for inflation for the rest of the year?
For inflation for the rest of the year, I think we assume that the Fed is going to remain largely on the sidelines in this mix. For the rest of the year, though, there's very little in terms of additional wind at the back of declining inflation rates for the remainder of the year. At some point, yes, the pressure from housing is going to have to slowly start to abate. But as we've seen with more recent rents data or with home sales, the housing market hasn't quite slowed down to the extent you would have thought, with mortgage rates cresting above 7%. Given that backdrop, it's hard to see inflation falling back towards the 2% target at any point towards the end of the year. In fact, it may be hard for inflation to get marginally below 3% before the tail end of the year, unless we see some other large shift in the economy.
Yeah. Nancy, how about you? What's your perspective on inflation for the rest of 2024?
Yeah, again, I agree with a lot what Jason is saying, but going back to that shelter component, the housing component, there's some structural things that have been going on for a very long time. I think it's adding to that stickiness, right? For the past 10 years, supply and demand in the housing market, there's been way more demand than supply.
Right.
I think when you look across the country, builders have been more paid better to build in luxury sectors than mid-markets and lower income sectors. So that's kind of made this gap in the housing market. And then when you take into the employment, right, you need tradesmen, you need experienced and educated tradesmen to build homes for safety purposes, right? And there's a timeline to fill in those careers. So you have that gap there that I think continues to make inflation sticky. Yeah,
hence the stickiness. That's true. So Jason, in light of all this, how do you think the Fed reacts if inflation stays at its current level, doesn't subside as hoped for the next let's say another 3 months till the next meeting?
I think number one, it's important for the Fed to continue its data dependency. Yep. They started down this path, they need to continue down that path. In terms of the short term, over the next few months, when we get to the June and July meetings, even out to the September meeting, if we see inflation follow the path that I outlined in the last question, that it really doesn't move materially lower from here during that time frame, the Fed continues to sit on the sidelines. Yep. They understand they're in restrictive territory, meaning the Fed funds rate is in excess of the core rate of inflation right now. So it should, at some point, have an impact. But because of the preponderance of fixed rate lending, particularly on the consumer side and mortgages, there's less reactivity to Fed interest rate moves, meaning it's going to take a lot longer for inflation to just gradually abate over time as people slow down their rate of consumption. Yeah. That's a time problem. That's not an action problem.
Got it. So higher for longer, probably.
Higher for longer.
Nancy, anything else to add on this topic?
Gosh, I sound like a broken record.
No, that's fine.
I agree with.
That's fine.
I do agree with what Jason's saying. I'm not sure this 2% holy grail is something we should be chasing, or not chasing in the near term. I feel you need some structural changes to get back there, and I think AI comes up in every conversation we have. It's going to take time again for people to understand how to use it and get it working across industries for that to kind of give us some, inflation relief.
Yep, good point. Thanks, Nancy. So let's shift the discussion a little bit, from inflation to the broader health of the U.S. economy. And before we do that, amongst our panelists, let's return to the audience and post our second polling question. And that is this: what will be the economic result of the Fed's current policy cycle? So now we're talking about soft landings and the like. So there's actually a new term, which is no landing, which is sustained economic growth. Secondly is a soft landing, where you have a slowing economy but not falling into a recession. Third option is a shallow recession. And then finally, a significant recession is option number 4. So please, our audience members, take a moment to respond to the polling question, and we'll come back to it in a minute. But Jason, I'll start back with you. I'd like to get your overall assessment of the current state of the U.S. economy.
Current state of the U.S. economy. We've talked a lot about inflation, and that's been topic number 1 when we talk about the economy. Nancy actually mentioned the second area, and that's the Fed's other side of their mandate. The Fed's other side of their mandate is full employment.
Yep.
And Nancy mentioned the health of the employment markets earlier. On a headline basis, we still have an unemployment rate that's below 4%. That's important because the Fed has oft said that the natural rate of unemployment is somewhere between 4 and 5%. So we're beyond what we would call full employment in the economy. With that type of backdrop, you start to worry about a mid-1970s type scenario where you get wage push inflation, where wages grow faster because prices have grown faster, consumers demand more from employers to keep up with those price changes. But then you get the same problem of too much money chasing the same amount of goods that creates another inflationary push. While wages are growing at a bit faster than historical average rates, they're not an order of magnitude like they were in the 1970s. So I'm not worried about wage push inflation at current levels. The employment markets are also starting to show some cracks. We're seeing a marked decline in job openings, a decline in the hires rate, a decline in the voluntary quits rate, so less people quitting their jobs for a better job somewhere else, and a slight uptick in layoffs, although we can thank the technology sector for that early in the last year. So as we see that backdrop in employment markets maybe starting to soften a little bit in reaction to changes in consumer demand, we look at consumer consumption. And the consumer's largely held up fairly well.
Yeah.
Consumers still spend money, retail sales continue to advance, but if we inflation adjust those, they haven't moved.
Right.
There's only 2 positive months of real retail sales since this real economic cycle started, meaning we are just paying more for the same amount of stuff. At some point, that catches up to an economy and growth rates slow.
So Jason, I'm going to stick with you with this because we're talking about economic cycles, and I'll ask you to put your chief economist hat on for a minute. Can you share your thoughts on sort of the classic boom and bust economic cycle? Some in the press have suggested that maybe the classic cycle is dead, and that these recessions are overblown, and that if you look back in since the 80s, there haven't been nearly as deep and long as recessions as we see in our in our books, in our economic books. Can you speak to that? Do you think that there's sort of a new normal here with respect to economic cycles?
It's funny you use the word new normal. It sort of reminds me of Alan Greenspan's favorite phrase, or least favorite phrase, this time it's different.
Yeah.
It's very true this time around, too. I think the important observation when it comes to economic cycles is not that cycles are over or that cycles don't exist any longer. As the economy has matured and moved forward, cycles have gotten longer.
Yeah.
We used to talk about economic cycles, if you go back to the 50s, 60s, early 70s, as 3 to 5 year cycles. And you look at those cycles, and we had a number of cyclical recessions in that time frame. They would be 6-7 month recessions at the end of a 3-year economic cycle. That was almost with regularity. As we moved through the 80s and into the 90s, those cycles lengthened out to 5, then 7 years. Now we're lengthening these cycles out to, it seems, 10 years or maybe even more. The reason being, one, we're growing at a slower rate. In the 50s and 60s, it was 3 to 5%. We slowed to the 3% rate in the 80s. Now, on a average basis, we grow at about a 2.25% clip for GDP. Growing at that rate, one, only supports 2% inflation, so that's important, that inflation can't grow faster than the economy without causing issue. But two, growing at that slower rate means we've got a longer window for the economy to reach any sort of stall speed, to grow too fast, too far. And I would expect we continue to see, as the economy has matured and is likely to stay at this level for some time, long cycles that are rarely ended by cyclical type recessions, as we saw in the 50s and 60s, and more often by structural type recessions like we saw with the bursting of the internet bubble or with the credit crisis in '08 and '09.
Got it. So there's still this isn't exactly a new normal, maybe just a stretching of the economic.
Just stretching the rubber band a little.
Yeah, all right, well, great. We'll go back to the results from our audience on poll question number 2. And it looks like we have a close 44% versus 41%. 44% of folks are saying we will have a soft landing. And then 41% suggest that we'll have sort of a shallow recession. The other two extremes are pretty minimal. So generally pretty optimistic, I would say, from our audience. So the sentiment is, I think, relatively consistent, Jason, with what you and Nancy have outlined so far. Let's talk about what the bond market is telling us, Nancy, because the yield curve has been inverted for some time. It's certainly, historically, people look at the yield curve as kind of especially an inverted one, as a precursor to a recession. So, Nancy, what's your view of the direction of the economy in that light, and any likelihood of a recession, especially from the lens of the fixed income markets?
Sure. So we have this inverted curve for over 20 months now, which is a record. So what that means, when the Fed implements their Fed rate policy, it affects the front end of the curve.
Yep.
So we're getting a higher yield on the front end of the curve versus a longer end of the curve. So you end up with this kind of ski slope from, call it 2 years to 10 years, right? Normally we have more of an uphill in a more normal curve. So as the Fed raises rates, that's bringing the front end up. The back end, all boats rise, so it has come up, but it's still got this curve shape of a very steep curve. We've been anywhere from, I think, 120. Right now we're around 40 basis points of steepness. That measures your yield from the 2-year to the 10-year. And allegedly, as Jason alluded to, it used to be 6 to 12 months. It would indicate that we were going to have a recession. Now they say 12 to 24 months and maybe even longer. We're fine with it, with how we're investing. A Fed on pause means that we're going to continue to have the interest rates up here. And then you have your short-term investor who's capturing, these lovely yields in the 520s and 530s. But you also have pension funds and insurance companies who like to immunize their liabilities, and they can now go out on the longer end of the curve and invest in not really treasuries, but you can go to single A's and high-grade bonds and capture these very high yields, which is helping everybody out. So I think you're getting this kind of push me, pull me, where the Fed continues to keep rates high, so the front end stays very high, but we also have a good backbone investing in the longer end of the curve, which is keeping that down. So as long as the economy continues to be in a positive view, I think we're going to continue to see that. I think we saw a little bit getting back a little bit to housing market, we saw a little bit of a surge in people, I think, finally saying, okay, mortgages are high, but we're going to go and buy that house anyway. So we saw some faster prepays, which suggested some movement in the housing market. But I think people are a little bit premature in thinking that rates are going to come, right down. And like we said, there's no rate cuts coming. So I think people kind of jumped and said, oh, we'll hold this higher mortgage for a few months, and then we'll, refinance it and move on. So
got it.
And I think anybody waiting for rates to drop to enable a home purchase or to enable a refinance is probably going to be waiting for a little bit longer than expected.
Yes, I'm sort of waiting for Godot.
Jason, how about you? If you look at the yield curve and the other indicators, what's your outlook for the U.S. economy?
I agree with Nancy's idea that the stretched economic cycles are also stretching out those indicators. So whether we look at the inverted yield curve as a recessionary indicator, or we will look at other activity-based recessionary indicators, because the cycles are longer, those times, those precursors to recession likely lengthen out. I'd actually take the yield curve a little further and say that we're in a world now with so much fixed rate debt, particularly on the consumer. If we go back a few decades, we were talking a near 50-50 split between adjustable rate mortgages and fixed rate. Forbes recently put out earlier this year that out of refinancings over the last 5 years, 93% of them were done in fixed rate mortgages, below 4%. Now think about that. We had a lot of refinancing activity over the last 5 years, and those mortgages are all sitting at very low rates. Very hard for the Fed to impact the consumer from a change in borrowing unless either the consumer now has to borrow more or they are in the minority of people still in an adjustable rate product. So if that's the key to the Fed impacting the economy, that inflection point is 24 or 36 months out into the future.
We all know friends and neighbors who are sitting on these low rate mortgages and they're not going anywhere.
Even empty nesters, right? If you were an empty nester planning to move to Florida 5 years ago and to buy a nice condo once the kids are out of the house, kids are out of the house as of last year, and you looked and you did the smart thing and you refinanced with your Wintrust mortgage lender at a great rate over the last couple of years, and let's say you're sitting in the 2s, you're sitting below 3%. Even though you've got way too much house, you've got a nice big 4-bedroom house for 2 retired individuals, you're not leaving that house.
You're not going anywhere, yeah.
You're going to increase, because of that increase in Florida real estate and the increased borrowing cost, you'll actually pay more to make that move than you would if you just stayed put. And a lot of those folks are staying put. Nancy mentioned the supply issues we're having in the real estate market today. That's why you haven't seen the price of existing home sales fall by more than $15,000 a unit over the course of the last 2 years.
Yeah. Hey, Jason, I want to go back to the polling question because, again, our audience suggests, that they think a soft landing is coming or maybe a shallow recession. But, just last month, a recent survey of global fund managers showed that 36% of fund managers believe that we're in store for a no landing, which was our first category here. Can you talk to that? I mean, what does that mean exactly, and do you think that's a realistic scenario?
Well, the reality of a no landing scenario, and I don't mean to cast shade on those others in the industry that might be a little smarter than me with mutual funds that they manage, but the idea of a no landing scenario means the economy continues to grow at the rates we saw at the end of last year, not the 1.6% rate we saw in the first quarter of this year, but the rates we were growing at the end of last year. A rate in excess of the 2.25% we were actually growing at historically on average. If the economy grows at that rate and inflation is already hanging out around 3.5%, and we reaccelerate from 1.6% growth in the first quarter to, let's call it 3.5% growth by the end of the year, the only real economic outcome of that is higher inflation. And if inflation reaccelerates from here, the Fed again is data dependent, they will feel compelled to switch policy position.
Right.
And I think even just a shift to a hawkish tone in the Fed's comments will be enough to upend markets. Much less if they actually have to come off the sidelines and hike rates at some point in the near future. That could be disastrous for markets.
Yeah. So this is back to our earlier conversation. I mean, cycles still exist. It's not like
Absolutely.
it never gets, this thing ends at some point. Okay, thanks, Jason. So let's shift our attention to the markets. And Nancy, I'm going to start with you because we'll talk about fixed income.
Sure.
There's been a bit of a bifurcation in the market, with high yield and emerging markets debt up 11% and 18% respectively over the past year, while other benchmarks are flat to down. What has been driving the disparity of performance, in the various categories in the fixed income market?
Sure. So I'm going to just set a framework that it's been a risk-on environment.
Yeah.
So meaning emerging markets, most risk is going to outperform your high yield, which is going to outperform high grade, which is going to outperform treasuries.
Right.
Also, we're in a rising interest rate environment, so a shorter portfolio, shorter duration is going to outperform a longer portfolio. And so with that framework, that alone gives you emerging markets, really coming up on top. But when you dig into emerging market debt in emerging markets, it's a very complicated market. But the gap between yields there, or interest rates, and interest rates in the United States is very big. And so eventually, when rates do come down, the dollar value of that basis points as rate comes down in emerging markets is going to be very impactful. So you will see much better performance. Same thing in high yield. High yield is generally a short part of the curve, right? It's more risk, so investors aren't inclined to give money for 30 years necessarily to a high yield company. And I think investors have become very comfortable kind of in that double B and higher space. Triple C's have kind of lagged there. It's a little nuanced, but it's short. So you can kind of look at cash flows and look, we have a good economy, we have a good consumer, and feel comfortable moving down in the credit stack there. So that being said, But you can also get great yields in single A's. You don't have to take that much risk on, and just book that yield and carry that for the duration of the holding.
And you may be already answering the second question, but it's in light of the environment we just talked about with the higher rates at the short end and risk on today with the expectation of lower rates soon. What is your team, Mr. Morrissey and the fixed income team at the Great Lakes Advisors Group? Where do you see opportunities, and how are you positioning portfolios for our institutional and private client investors?
Sure, we discuss this every day. The beginning of the year, our portfolios were around, call it 85 to 90% of benchmark duration. So meaning we were just focused on a shorter duration, so less exposure to dollar price movements in the market. But we said, hey, we think the Fed is done raising rates, so we're kind of in this glide path. So let's take pay downs, maturities, coupon payments into portfolios, mortgage pay downs, and natural maturities, and start to normalize the curve. So we have moved our duration out more to the 95% area. So we still have this 5% of flexibility.
So still below the benchmarks, but
Correct.
Closer to them.
Correct. And that's worked out very well because we've seen rates kind of go up here. So that's been positive to our performance. But we also have maintained risk on. So we've maximized our clients' guidelines, right? We customize our portfolios. We've maximized that to continue to get that extra yield.
Yep.
One risk that I do see in the marketplace is if the Fed does start to move down, whatever, maybe there's some geopolitical issue or something that causes them to move. We'd start to lay people off, something like that. We do have that 5% gap. So that would mean that interest rates start to come down. That means we didn't lock in the higher interest rates soon enough.
Got it.
So I think we've really been very nimble in moving that out, not trying to time the market. It's very volatile, so you don't want to just wait for some kind of level, but to just keep naturally moving those portfolios out has really worked out well for us.
Great.
And keeping that risk on.
Sounds prudent. So Jason, you look at this from a little different vantage point. Nancy and team are specifically focused on fixed income, but you're responsible for our multi-asset strategies across Wintrust Wealth Management. So in light of the economic backdrop and rates, as we talked about, how are you positioning portfolios in MAS, if you will, today?
In our multi-asset portfolios, at the beginning of the year, we made a similar decision to what our fixed income team decided in terms of adjusting duration. We had a higher cash weight in the balance of last year as a defensive measure. I think 14 economists out of every... the joke is that economists have correctly predicted 14 of the last 4 recessions. and they certainly did that last year. We were all going into recession at the end of last year, the beginning of this year. And in that world, we had some safe money off to the side in cash and ultra short term. We took that money and deployed it mostly into core fixed income at the start of this year as we started to move out duration in portfolios as well. We also upped the equity exposure because that risk on environment rewarded a higher weight within some of the equity sectors.
Right.
And so we shifted our asset allocation a little bit to start the year, and it's quite frankly benefited clients that have been invested in those multi-asset strategies versus where they would have been positioned at the close of last year.
Got it. Good. Nancy, we talked about this a little bit with the Fed balance sheet moves, but the sort of quantitative tightening of the Fed, I think a lot of it is around the mortgage-backed market where you've seen the impact. But can you just explain how that's affecting the markets, the Fed, as they try to shrink the balance sheet here?
Yeah, so they're not the lead participant as they're shrinking. They also, at a certain point a year ago, they were saying they might have to sell the balance sheet, right? So that puts the market in disarray.
Yes.
Because who's going to buy it and what's the clearing level? So that's been a hindrance definitely in the mortgage market, but it also affects the treasury market.
Sure.
But what we've seen is foreign buyers stepping up. Also in kind of corporate credit, you've seen a lot of inflow into that, right? Corporate credit in the high grade space is actually pretty tight. It's around plus 100, call it.
Is generally investment grade, is that what you're talking about?
Yes,
Okay.
investment grade, sorry.
No.
And it's around plus 100, which is technically a pretty tight level.
Yeah.
But, right, we seem to have this glide path with things we've all talked about here. A good economy, corporation balance sheets, showing a little erosion, but still in good shape. good consumer. So it's given us this glide path to capture this incremental yield,
Yeah.
which the spread from your risk-free asset, your treasury, into these other sectors is giving us really great performance. We're carrying very well.
Yep.
So there's yield appeal. So even though the Fed is backing off, not so much in the mortgage market are we seeing people towing in too much yet, but at a certain point they will, because you have mostly government agency rated bonds that you can get at great yields. So I think there will be some inflection point there. But in other sectors, it's kind of game on, and let's just keep going. And that's been strong.
Great. Thanks, Nancy. Okay, let's shift to the equity markets, Jason, in just a second. But before we do so, we'll go to the audience and ask our third and final polling question. And it is this: how do you think equities, and measured by the S&P 500 will be equities, will perform for the rest of 2024? So we've got 4 buckets here: down 10% from current levels, flat to down 10% for the rest of the year, between flat and up 10% for the rest of the year, and then finally up more than 10%. So please take a moment to complete the polling question. And as we tally those, I'll ask Jason. It's been a pretty good run of late in the equity markets. S&P's up 12% year to date, 28% over the past 12 months. And you see now small and mid and international equities starting to get into the, onto the bandwagon with large cap, which has been really the driver for some time now, Jason. Are you concerned about current valuations in the equity markets, Jason?
I would say current valuations in the equity market, and we're going to concentrate mostly on PE, and I like using, as I think you're seeing on your screen, Professor Shiller's cyclically adjusted PE, or CAPE ratio. I would call it guarded. We're certainly at an elevated level of equity market valuations into the first standard deviation, and that's generally a level at which we start worrying about correction in the markets, given that valuations have stretched so far. There are underlying fundamentals and benefits, though, to equity securities today that, despite the first quarter being the 4th best start to a year in the last 30 plus years, may provide a little bit of support for current valuation levels, at least in the short term. And that would be the strength of corporate earnings that we've seen most recently. And yes, the comparables may be a little bit easier the beginning of this year to the beginning of last year, and that may play into the midpoint of this year. But I would be guarded about equity direction from here. I'd also throw in this is a election year. And generally in an election year, the end of the second and the entirety of the third quarter are the worst performing quarters of that election year. Why? Markets don't like uncertainty. They like some certainty. And in a presidential election year and a meaningful congressional election year, the direction of government regulation and taxation can have an outsized impact on certain sectors of the market. Sure. And the market not knowing who's going to win in November creates this level of uncertainty where markets don't know where to react. Now, usually what that then breeds is a jump after Election Day, particularly in those sectors that would be benefited by the incoming new political policies.
That's right. So, Jason, sticking with the markets, and this has changed a little bit lately, but like the fixed income markets, we've seen equity performance driven by sort of certain pockets really carrying the water for the markets, especially large cap growth and technology stocks. Can you just educate us on what drove that outperformance by that part of the market? These large mega tech stocks, and obviously AI related in a couple cases. And what does it say about the health of the markets and the economy more broadly?
Great question, Tom. We started off this run in large cap technology growth stocks talking a lot about the Magnificent Seven.
Right.
Those 7 stocks that kind of left the rest of the market behind and started screaming to the stratosphere. Earlier this year, I had someone coin the phrase Fab Four. Now, that's not a new phrase, of course, for any of us who remember the Beatles. But 3 of those 7 had dropped out earlier this year because their fundamentals weren't keeping up with their valuation. In effect, in my mind, that Mag 7 is really down to NVIDIA by itself now. That stock doesn't seem to be slowing down anytime soon. And there's your AI connection. The potential for AI to materially impact and obviously already impact the revenue stream for that company has been significant. However, it's a bit of a poster child for the valuation stretch that we talked about in the last question. I think more importantly for the direction of equity markets from here, is that we've observed that the equal weighted version of the S&P 500, now for those of you that don't know, the S&P 500 is a market capitalization weighted index. So the largest companies, think Apple and Amazon for example, have an outsized impact on the return of the S&P 500 that you read in the paper. The equal weighted version ascribes an equal weight to all of those stocks, meaning the other 493 stocks in the S&P 500 outside the Magnificent Seven have just as much influence on the direction of that as otherwise. The equal weighted version over the course of the last few months since the tail end of last year to now has outperformed the capitalization weighted version by 75 basis points, meaning we are seeing some rising tide for the rest of the equity world move up higher. That's an encouraging sign to see, simply because it's unsustainable to have 7 stocks be the source of nearly 83% of the performance of markets for a long period of time.
So thanks, Jason. So it's interesting. You talked about guarded and sort of the concerns about the volatility and the uncertainty in an election year, but our audience isn't worried about that because it says they are flat to up 10% is the vast majority. I'm trying to read that. It's more than 50% of the people say flat to up 10%. The next biggest bucket is flat to down 10%. So a little bit of optimism here from our crowd.
And I don't think it's unwarranted optimism. I would probably put myself right now in that flat to up 10% camp with a very extreme weight towards the flat end of that curve. I just think it's going to be a roller coaster for the rest of the year. I think you'll get a typical election year performance pattern in markets. We are due, even despite the pullback in April, we're due for a decent correction this year. And as a reminder to everyone, you get 5% corrections every year in the market. You get 10% corrections almost every year in the market. And we are certainly in store for something that we maybe fight our way back from by the end of the year to finish at or slightly above current levels.
And so, Jason, that sort of begs the question: what particular areas do you see opportunities, and how are you positioning the kind of the equity component of portfolios for your customers?
Well, where we see opportunities on a go-forward basis, we are late cycle in terms of an economic cycle, in terms of a market cycle. So we have a slight favor for large caps over small caps, despite small caps performing a little better here in the second quarter. We also find that valuation starts to matter, particularly when that earnings tailwind starts to peter out. And there are frankly better valuations outside the United States than there are inside the United States currently. We are seeing a real divergence in global economies. Europe, in effect, has already reached the point at which rate cuts make sense. England actually went through a very short recession, and the UK's emerged from that recession, it looks like now, and ready to address that with monetary policy changes. Japan is living its own economic reality after 3 decades of basically moving from nowhere. And China is on the complete opposite side of the cycle spectrum. Given that environment, being a smart, actively managed portfolio manager in the equity space is of paramount importance here. You need to avoid the pitfalls. You need to find the areas of opportunity, and a good international influence strategy can actually be rewarded, particularly if the dollar weakens. The dollar's been strong for a long time. Dollar can stay strong, international stocks can still outperform, but if the dollar weakens at any point because of an economic shift here in the United States, you could see international returns. Nancy pointed to it with the idea of emerging market debt. You could see those returns get a little supercharged.
Yeah, you're starting to see several tailwinds on the international front, it sounds, and you've been positioning portfolios in anticipation of that. One other thing that comes to mind is commodities, Jason. You've also been positioning portfolios with commodities and infrastructure, securities. Can you just speak to that? Obviously inflation has helped on the commodity side, but we've seen record levels of gold and silver and the like. So what's your take right now with respect to commodity exposure? I
think we have seen commodities first influenced by expansion in China and the rest of the developing world, but more directly from inflation. And that's when we stepped into commodity markets, is when we started to see the initial winds of inflation some 3-4 years ago. We have reduced that weight somewhat over the course of the last year and a half, simply because that tailwind isn't there for commodities to grossly outperform. I'm not expecting that commodity prices jump significantly from here. Silver's at significant levels from a metals perspective. Gold too. There may be defensive benefit in gold depending on Fed direction, depending on direction of the economic movement, but commodities as a full basket
Yeah.
We've lightened up weight there a little bit because the tailwind isn't there anymore. Infrastructure is a different story. Infrastructure is actually, through yesterday, the best performing sector that we allocate to in the second quarter. And it is simply because they're great cash flow businesses with floors on their valuations. You buy ports and toll roads, cell towers, things that you need for the modern world to function the way it functions. Those asset prices create a nice floor, and they also are high cash flowing investments. So in a world where we're competing with fixed income now at 5 or maybe even 4.5% rates, if we go further out the curve, infrastructure can keep up from the equity side, and that's shown through in performance in this quarter.
Excellent. Okay, so we are really at our time, but I have so many questions from the audience. I'm just going to tee up one of them, Jason, and you maybe leave us with a teaser for next time. But what is your opinion regarding how the state of the economy will affect the presidential election we have here in the fourth quarter?
That's a great question, and you know, when we meet again in 3 months or 4 months' time, we will certainly spend a lot more time on the impact of politics and the economy. I will answer that first with a Trivial Pursuit question. And this is one, if anyone's heard me present anywhere recently, I've sprinkled into the presentation. But only once in history, since the onset of the Civil War, has the United States re-elected a president to a second elected term, and I word that very carefully, re-elected a president to a second elected term when there's been a recession within 2 years of Election Day. As of right now, there's been no recession within 2 years of Election Day. That one time is actually 1900, the election of William McKinley to his second term. Which of course was cut short. But the election of McKinley to his second term with a recession within that 2-year window, if we flip that around the other way, we have never failed to elect a president to a second elected term when there is no recession within 2 years of Election Day. That is not to say that history will hold true in this election cycle. We're barely getting into it from here. And a lot will happen between now and the fall that we'll unpack next time we meet. But I will say that the economy is certainly impactful in terms of the political direction the country takes. The buck has to stop with somebody, and if there is a recession, it's pretty easy to blame the guy in the White House.
I got it. And as you mentioned, Jason, we'll be talking quite a bit more about the election and the political landscape the next time we get together. So, but unfortunately, that's all the time we have for today. We want to thank you all for joining us on this afternoon. By the way, a recording of today's event will be made available on our LinkedIn page very shortly. In the meantime, you can follow Jason Turner's Thinking on the Economy by reading his weekly market update, which you can see by following Wintrust Wealth Management on LinkedIn or requesting that your Wintrust relationship manager send you an email every week. So thank you again, everyone, and have a great rest of the week and a nice summer. Take care.